Hi everyone. So welcome to the stream today. Really excited for having you on the stream as we continue with our discussion towards the November 2025 examination. We've been looking at practice questions in respect of various key areas that we need to be mindful of in various subjects. Now, in case you missed some of the sessions, you can check the playlist on the channel, and you will be able to get access to all of the videos as well, so you can prepare well for the examination and pass the exam. Remember also that you can enroll in our full practice question courses on our website or in the Nhyira Premium mobile application. So we have the full practice courses for all of the subjects. So we have for management accounting, advanced audit and assurance, financial reporting, corporate reporting. So you can enroll in these exclusive practice question courses that gives you access to practice questions on these subjects in all of the key areas that you need to understand to put you in the position to pass the examination. As I say always, going into the exam hall, what you are doing is that you are going to be applying principles. But the only way you can apply the principles is by understanding the fundamental issues when it comes to the topics. Now, once you understand the fundamental issues in respect of the topics, then you can open yourself up to questions. And these questions are carefully selected, covering various areas of the syllabus in financial reporting, corporate reporting, management accounting, advanced audit and assurance that you get exclusive access to. Then you can also join our executive leadership masterclass, because our executive leadership masterclass for the November 2025 examination is starting on the 20th of October, so 20th of this month. It's going to be a 2 weeks executive leadership masterclass with some exclusive sessions where we spend time with our students, hold their hand, provide them with the blueprints that they need so they can pass the examination. So head on to our website. You can join our executive leadership masterclass by enrolling in any of our practice courses, get access to these contents, and also join our Executive Leadership Masterclass. Study under my mentorship with the team here. Let us give you the guidelines you need so you can go into the exam hall, write the exam with confidence, and most importantly, pass the examination. If there are any questions also, you know what to do. You put them in the comment section or the chat box. I want to hear from you where you are watching us from. And most importantly, if there are any specific things you want to pick my brain on, maybe a topic you are studying or a question that you want me to look at, I will really be excited to look at that to help you so you can pass your examination. Remember to also share the video so we can reach as many students as possible and assist many people across the world. So let me bring up my screen quickly and let's get excited into our discussion. Remember that our books are also available that you can get access to: public sector, financial reporting, advanced audit and assurance, strategic case study, corporate reporting, taxation, management accounting, financial management. You can get copies of all of these books. Just call or WhatsApp the number on the at the right below the screen, the right down corner below the screen, and you'll be able to get access to these books so you can pass the examination. We are going into 15 marks or 20 marks area in the exam hall, and that is evaluation of financial statements. Okay? Evaluation of financial statements, or what we will call ratio analysis. So, evaluation of financial statements. Now, it is important you understand that there are a couple of perspective, styling, choice of questions that the examiner is going to be bringing when it comes to evaluation of financial statement. So let's begin the journey first by walking you over again into the overview and the styling of ratio questions that the examiner is going to be getting goosebumps on in the exam hall. Thought I had opened this already. Give me a sec. Let's see if I can quickly bring this up. Ratios. Give me a sec. Yeah, I've seen it. Let's go. So when it comes to evaluation of financial statements, there are some styling of questions that the examiner is going to be bringing that you have to be mindful of. So number one, just a simple question to calculate and analyze the ratio. That's one styling of question, sorry. Number two is just for you to analyze the ratios. So you are not doing any calculations. Computations have been done already. So all the examiner is asking you to do is to analyze the ratio. That's the second styling of questions. Third is vertical or common size analysis styling of questions, where the financial statements are represented or presented in a percentage format, and you're going to be using that as a guinea pig to then analyze the performance position and the cash flow condition of the entity. Then changes in business. So this is where during the current year under review, the entity has disposed of part of its business or has acquired a subsidiary during the year. How do you deal with that ratio? That's the type of question also there. Then financial statement with additional footnote where we have to make amendments. So this is an advanced type of ratio question where we are presented with financial statement with footnotes. So we're going to be applying the accounting standards, the conceptual framework to present the financial statement for the entity for the period under review. That's another styling of question. And then the sixth one is the consolidated cash flow analysis, which is exclusive to the corporate reporting students. So as you are going into the exam or for ratio analysis, for this 15 marks or 20 marks area, depending on where you are standing at, these are the styling of questions that the examiner is going to be. One of them will be there for you. And so it'll be important for you to expose yourself to all of these styling of ratio questions so you can really know how to deal with them. Because it's not just about, yeah, I know how to calculate the ratios. No, it's about knowing the structure of the questions, the way you are supposed to approach the questions, and most importantly, how you write out your analysis, because that is how you can then position yourself to go into the exam and ultimately pass the examination. So these are the 6 styling of ratio questions that you have to be mindful of. But for the purpose of my presentation today, I'm going to be focusing on the first styling of question, where we are just given a set of financial statements, and so we will calculate the ratios and interpret the ratios there as per the requirements of the question. So let me bring back my question, and this is the ICAG July 2024 financial reporting. ICAG July 2024 financial reporting paper, and we are looking at question 4 because that is where evaluation of financial statement is for 20 marks. So let's go into the discussion here. A says compute ratios for Momo farms for the year ended 30th September 2023, equivalent to those calculated for the year ended 30th September 2022. Okay, so let's put up our company down. Moma Limited or Momom Limited. So let's read the question and see if there are some things we can get goosebumps on as we proceed in the discussion. Below are the recently issued summarized financial statement of Momo Farms Limited, a listed company, for the year ended 31st or 30th September 2023. Together with comparative for 2022 and extract from the chief executive's report that accompanied their issue. So we see the P&L account. Remember, we are doing the calculation for 30th September 2023. Okay, that's what we are doing for. Then we see the statement of financial position also coming up. Let's ignore everything. Extract from the chief executive report. Highlight of Momo Farms Limited performance for the year ended 30th September 2023. An increase in sales revenue of 34%. Now, this is going to aid us in the analysis side of the notes. Okay, the analysis side, the B part of the question. It is not going to influence our calculations of the ratios, but it will aid us in the analysis side of the ratios, and we'll come back to that in a moment. Gross profit margin up from 16.7% to 20%. A doubling of profit for the period. Okay, so that is what we are looking at here. And you can see that as the profit for the year has doubled. Last year it was 7.6, now it is what? 7.2. Revenue was 108, now 150, and that is why the Chief Executive Officer's report is indicating that there has been increase of about 39%. So those are going to be aiding us in writing out our analysis. Let's continue. In response to this improved position, the board paid a dividend of 10 pesos per share in 30th September 2023, an increase of 20% on the previous year. So that is a good thing. They paid dividend. Again, if there is anything that is going to come or feed into our analysis in the write-up and nothing to do with our calculation. The following ratios have been calculated for Momo Farms for the year ended 30th September 2022. So we've been given the ratios for the entity, but last year, and that is where we are going to be calculating for the current year. Then based on that, we can then write out our analysis in that case. So what ratios are we calculating? First, return on year-end capital employed. Return on capital employed. So return on capital employed. Now, if you pay attention to this question also, the examiner has given you the formula for calculating it. That's quite generous from the examiner, right? It is profit before interest and tax over the total assets less current liabilities, okay? So PBIT, you write that in full, divided by capital employed, because you must write down your formulas, times 100, okay? Times 100. That's the idea. Now, what I want to do is to have my formula on one side, and then I'll have the computation on another side, okay? Just want to keep my things in a certain way, so permit me to do that. Or better still, since it is just for 1 year, we can keep it like that and calculate. Let's keep it like that and calculate. So what is the profit before interest and tax? Let's go to the P&L account. Stay with me carefully. You can see here that we have profit before tax, and then we have gross profit and operating expenses. So to calculate the profit before interest and tax, there are 2 ways this can be calculated. 2 ways. The first way to calculate this will be, for instance, give me a sec. So the first way to calculate this will be to just less the operating expenses from the gross profit. Okay, so when we subtract the operating expenses from the gross profit, that's 30,000 minus 15,600, and that is 14,400. Okay, so 14,400. That's one way to calculate it. The other way we could still calculate the profit before interest and tax is to add back the finance cost to the profit before tax figure. So that is going to be 9,600 plus 4,800, and that is still 14,400. Sounds good? So these are the 2 ways we calculate the profit before interest and tax. We take our gross profit, less operating expenses, boom, we are gone. Or add the finance cost back to the profit before tax figure. Why? Because the finance cost was deducted in arriving at the profit before tax figure. So if I add back the finance cost, it will now give me the profit before interest and tax figure. That is the idea about it. So profit before interest and tax, 14,400. We bring that up. Divided by capital employed. We are told that capital employed should be total asset less current liabilities. So if we check here, total asset is 154,800. Current liability is 26,400. So 154,800 minus 26,400. That is the capital employed situation. So we punch that out to give us the return on capital employed. So 14,400 divided by 154,800 minus 26,400 times 100. And that is 11.2%. You want to see the figures they provided. How many decimal places are they working at? 1. So to enhance consistency, we will also do to 1 decimal place. Okay, just to enhance consistency. So that is the return on capital employed, the first ratio. The second one is net asset. And they said the net asset is equal to capital employed turnover. So net asset turnover. So the net asset turnover is going to be revenue divided by capital employed. Hey, I wanted to do times 100. This is not times 100. You got to be careful. Because, I've had moments where students are giving assignment and net asset turnover, they are doing it in percentages. Because the other profitability ratios are in percentages, right? So revenue is 150,000. So we divide that by the capital employed, which we just used, the 154,800 minus current liability 26,400. So we punch that out, and that gives us the net asset turnover. I'm going to come to the analysis in a moment, so just stay with me. So 150,000 divided by 154,800 minus 26,400. And that is 1.2. Okay, approximately 1.2 times. So that is our net asset turnover. Next one, net profit before tax margin. Okay. So net profit before tax margin. What does that mean? It means we're going to use profit before tax, not profit before interest and tax, divided by sales, certainly times 100. So we go. Profit before tax, how much do we have? 9,600. Our sales is 150,000. So 9,600 divided by 150,000 times 100. And that is 6.4%. That is our net profit before tax. So let's see. The next one is current ratio, measuring the liquidity of the entity. So the current ratio is current asset divided by current liabilities. So current assets, go to the statement of financial position. Current asset is 22,800. Divided by current liabilities, which we used a moment ago, 26,400. And it looks like there's going to be a little problem. 22,800, 26,400. 0.86. So it looks like the entity cannot pay its short-term debt as a fall due. So there is no need to even calculate the quick ratio because they are already in the math. Next one, closing inventory holding period. Okay. IV, closing inventory holding period. The formula for this is very simple. We are going to be bringing in the inventory divided by cost of sales times 365 days. So, what is our closing inventory? Under the current asset in the position, 15,000. Cost of sales, which is in the statement of profit or loss, 120,000. Times 365. So how long does it take before we sell our goods? So that's 46 days, approximately. Okay, 46 days. Now, remember that there is a difference between inventory holding period and inventory turnover. But they are all measuring the same thing. The inventory period or the inventory holding in days, that is measuring how long it takes us to keep inventories before they are sold. And the lower the ratio, the better. But inventory turnover, that is looking at how quickly the entity sells inventories. And the higher that ratio, the better it is for the entity. So the two are measuring the same things, or the same thing, but you have to know how their calculation work. Next, trade receivables collection period in days. Okay. So trade receivables collection period. So we're going to assume that all the sales are on credit. So trade receivables. Let's bring this one down. Divided by the sales times 365 days. Because the idea is that this should have been divided by credit sales. But in the context of this question, we do not have credit sales. Okay, we are not told that the sales are splitted into cash sales and credit sales. So we will assume all the sales will be treated as credit sales. So trade receivables is 7,800 divided by a sales of 150,000 times 365 days. Let's see. Maybe 19 days. So again, if you check the context of this question, we don't have a lot of nuances. It's like pretty easy to go. Trade payables. So same idea, but now payables. So trade payable. And that is going to be the trade payable divided by cost of sales. Times 365. Again, the actual formula for this is trade payable divided by credit purchases. Very important. Okay. So trade payables is 13,800 divided by the cost of sales. What is our cost of sales? 120,000 times 365 days. So what do we have? $42 days. That's it about the trade payable days. Then, I think the last one, debt. It says it should be debt over debt plus equity. Okay. So that's a typical gearing calculation. Not debt to equity. So debt divided by debt plus equity. All right. In other words, we are measuring what percentage of the capital of the entity is financed using debt. So what do we have? 60,000 divided by 60,000 plus equity is 68.4 times 100. So we punch that out. (46.7%). This is the A part of the question, calculating the ratios. But we are not done, because after calculation of the ratios, B says assess the financial performance and position of Momo Farms Limited for the year ended 30th September 2023 compared to the previous period. Your answers should refer to the information in the Chief Executive's report. Okay. So before I do that, like go to the analysis, it will be important for me to put up the summary. So permit me to go back here and pick the 2022 figures. Uh-oh. Then I'm going to work with that. let's see. Okay. So this is the 30th September 2022. So now we have 30th September 2023. Gonna rule some lines. Now, this is not something you have to do or you must definitely do. But you have to do it because that way you don't have to be flipping the script back and forth trying to see what is happening. At a glance, you can do your analysis and then pick your things. Okay. So the 2023 gearing, maybe we can do 67%. Hey, 67 how? 46, so 47%. Trade payables, 41. Receivables, 19. Okay. Current ratio, 0.86. Inventory closing period, 46 days. Last but one. Net profit 6.4, 1.2. So 6.4, 1.2. Then return on capital employed 11.2. So this is at a glance what is happening here. Yes, ROSI is going up. Asset turnover has marginally reduced. And we have to analyze why that may be the case. We'll come back. Profit before tax increased. Current ratio is declining. Closing inventory is going up. But they are selling more in the current year than they were selling in the previous year. But the inventory holding is up. Receivables is down. Sorry, it's also up. Payables also up. It's also up there. And then gearing. Last year there was no gearing, so now we bring in another figure here, 47%. Okay. So how do we analyze this? How do we analyze this? That is the B part of the question. Assess the performance. Now, it just said we should assess the performance. So pro forma is going to be important. We will have the name of the company coming up. Momo Limited. Then, because it just said assess performance, the financial performance and position, that will be heading. So, assessment of financial performance and position. Then we write introduction. Please, this is a pro forma, and your write-up must follow the pro forma. Now, I'm not going to comprehensively write the analysis for you because, as always, you got to be writing the analysis. So my intro could read like this. This is the analysis of the financial performance and position for the year ended 30th September 2023 compared with the year ended 30th September 2022 using, now what kind of ratios are these? Profitability, liquidity, and working capital, as well as gearing ratios. So you write the core ratios in your intro, not listing them, using profitability, liquidity, working capital, or if you want, efficiency, and the gearing ratios. Sounds good? So that will be my introduction. Something like that. Then after that, first, the return on capital employed, the asset turnover, the net profit margin, these are profitability. So I will come to financial performance. Then I will start writing my analysis. After that, I can do the liquidity together with the efficiency ratios on the next paragraph. Then we come to the gearing. Okay, so each of these will be a paragraph. Then the conclusion paragraph will come. The conclusion paragraph is meant to do two things. One, tell us the overall performance of the entity. And then two, if there were some things that were not going on well within the organization as per our analysis, then we make suggestions or recommendations. And our suggestions or recommendations must be specific. When we are done with the conclusion, thank you. That's all. Now, it is not a report or a memo. If not, then we would have started with to, from, subject matter, date. Then these things will follow. Then we'll have a closure, sincerely yours, or yours sincerely, or yours faithfully, our name, signature. So the pro forma is very important there. Now, how do we interpret these ratios? There is a guiding principle that, as always, you must follow when it comes to the analysis of the ratios. And so let me take you into my presentation here. I think that Give me a sec. Let me see if I can re-pull my analysis document. Oh, okay. It looks like that's all I will get. Because I don't like the format, but it looks like that's what I'll get. So this is the guiding principle. Stay with me. The way we interpret the profitability ratios, as always, is that you're going to start from the top, then you walk down. So you're going to start with the asset turnover. What is happening to the asset turnover? Then you come to we don't have gross profit here, so you go to net profit margin. Then you go to the year end. So I want you to stay with me carefully here. The asset turnover ratio measures the utilization of assets in the revenue generation of the entity. So if we look at the asset turnover ratio, what's happening? The asset turnover ratio has reduced from 1.6 times in 2022 to now 1.2. So there is a marginal reduction in the asset turnover ratio, although the entity's absolute revenue went up by 30% from the chief executive, 39% from the chief executive's report. So why is that happening? Why has the revenue gone up, but the asset turnover ratio is reducing? It's because of the increase in the capital employed. If you check the financial statement, it's partly due to that. Last year, they were not having loan. And so this loan probably was brought in the current year. So the capital employed in the current year is more than the capital employed in the previous year. And if you are aware of fractions very well, when the denominator is increased, the ratio falls. So yes, the net asset turnover ratio, which assesses the efficiency in the utilization of assets in revenue generation, is indicating or is reducing marginally. Although the absolute revenue figure has increased by 39% as per the chief executive's report. The reduction in the asset turnover ratio could be as a result of the increase in the capital employed arising from the 10% loan note which was received during the year ended 30th September 2023. That's what's happening there. So the discrepancy in the capital employed might be what is causing the asset turnover ratio to reduce from 1.6%, from 1.6 to 1.2. Principles. So that is the way we deal with asset turnover ratio. Then you come to, we don't have gross profit margin here, so we're going to do operating profit margin. Now, so these are the guiding principles, right? You have this document already. So when analyzing the operating profit margin, what do? You have to make reference to your revenue changes, talk about the changes in the cost of sales if possible, then changes in operating expenses. So on our ratios, what's happening here? The net profit margin has gone up. Okay, from 4.4% to 4.6%. So there is increase in the net profit margin. Why is that? So if we come back to the director's issue, you realize that the increase in the gross profit margin can be due to the increase in revenue by 39%, increase in cost of gross profit margin also from 16.7 to 20%, and maybe better control in operating expenses in the current year than in the previous year. Because if you check here closely on the operating expenses side of things, you will realize that what's the percentage change in the operating expenses? 15.6, 13.2. That's 18%. Okay, 18%. And then revenue is going up. Cost of sales might be going up by around 33%. So the reason why our net profit margin is increasing could be partly due to the 39% increase in revenue, the increase in the gross profit margin, and maybe the entity having better controls over operating expenses in the current year than they were in the previous year. That's the idea there. The last one is return on capital employed, which has gone up. So you realize that although the capital employed for the year has gone up, our ROCE did not reduce like the asset turnover reduced. Our ROCE went up. Why? The increase in the ROCE can be attributed to the 39% increase in the revenue, the increase in the gross profit margin, and increase in the net profit margin. It means that on the overall, the entity is more profitable in the current year than they were in the previous year. That's our ROCE. And that brings us to the end of the profitability ratios interpretation analysis. I hope you get the guiding principles. Then it comes to the current ratio, which is measuring the ability of the entity to pay short-term debt as they fall due. As we mentioned, it has reduced significantly from 2.9% to 0.86. What does that mean? It means the entity in 2023 cannot pay its short-term debt as they fall due because its current ratio is below 1. But sales went up by 39%. So what's happening there? Because if sales went up by 39%, then he expected that there will be some more cash coming in. Which means that if we should calculate a quick ratio, it will be even worse. So we wouldn't calculate that here in the context of this question. But what's happening? Why? If you check the trade receivables days, you could see that that is going up by 3 days. What does that mean? It could mean that the entity might have to, or during the year, may have reduced it or made its credit policy quite flexible to be able to sell a little more on credit. That could be a reason. That could be a reason. Now, if you check the closing inventory period also, it has gone up by an extra 10 days. What does that mean? It means that in 2023, the entity is keeping inventories longer than they were keeping the inventories in 2022. So what's happening here? Although revenue went up by 39% in 2023, the inventory holding days also went up by 10. What does that mean? It could mean that it may not mean the entity is not managing inventories well. Probably the entity speculated that there is going to be increase in sales and hence bought a lot of inventories and kept them. Or the entity expects some increase in prices or increase in the inventory cost and hence bought more at the end of the year. So that's why we have a lot of inventories at the end of the year. Because if you check, we have inventory 9,000 last year. Now it is 15,000. So we have more inventories than we were having last year. And it's because we were selling more this year than we sold last year as well. So if you look at that image there, then we could say that, okay, although the entity is selling more this year, it's equally keeping more inventories. That may not mean the entity is having slow-moving inventories, although you can come from that angle, but it could mean that the entity bought and is keeping more inventories to be able to satisfy demands, future demands when they come. Or it could also mean that the entity is keeping more inventories due to expected increase in prices in the near future. So that could also be another reason. why that may be happening. Okay? And on the flip side, on the payable side of things, we are seeing the trade payable going up. It's not surprising because, as you can see, the current ratio reducing significantly. The entity doesn't have money, so it is taking longer to pay its suppliers. Then we have to ask ourselves a number of questions. Because the entity has gone for a loan of $60,000 in 2023. On the average, you would expect that that money will be available at the end of the year. But there is no money because at the end of the year, the entity is rather having bank overdrafts. Which means because last year they were having 8,400 before the loan of 60,000. So this 10% loan note, what did they use it for? Remember, we were told they paid dividend of 10 pesos per share. Okay? Now, if you check, let's see the number of equity shares. We have one city. So we have 60,000 times 0.1, 10 pesos. So 60,000, 0.1, and that's 6,000. So the loan that they went for, they used 6,000 to pay dividend. So what did they use the rest of the money to do? Maybe acquire some PPEs during the year. We are seeing goodwill even in the statement of financial position in 2023. We don't know where that goodwill is coming from, and there is no information about it. But in accordance with IAS 38, internally generated goodwill cannot be recognized. So could it mean that this is a consolidated financial statement, and during the year they acquired a business? And it is the business they acquired that is fueling that increase in the sales? It could be that in the 2023, we are now in a consolidated environment, but we are not because they didn't say consolidated P&L. So where is this goodwill coming from? So there's a lot of things going on here that we need to analyze. But the entity took a 60,000 loan, paid dividend of 6,000, and the rest might have been used to finance operating expenses. Then certainly, 2022, the entity was not geared because it was 100% equity. But now in 2023, the entity is geared. It has 47% of its capital coming from debt. But the question we need to ask ourselves is that bad? And so to conclude, we calculate the interest cover ratio, which could be profit before interest and tax divided by the finance cost. Because if the interest cover ratio is increasing and the company is geared, that may not be a problem like that because it means that the borrowed funds are utilized or are being used for profitable activities. And so profit before interest and tax, 14,400. Divided by interest expenses or finance costs, 4,800. So how many times will our profit before interest and tax cover our finance cost? So 14,400 divided by 4,800, that's 3 times. That's not bad, because if our profit before interest and tax can cover our finance cost 3 times, that's pretty okay. It tells you that, okay, apart from the dividend they paid, as we calculated a moment ago, from the loan notes that they issued, they might have used the rest of the proceeds and use it to finance some assets or finance the activities of the entity. That's the idea. And so in our recommendation side of things, what do we have to do? The entity must put some measures in place in order to deal with its liquidity position. But that is generic. So what should they specifically do? couple of things could be available. Number one is that the entity can offer early settlement discount so that the receivables can be paid. Then they can get some of the money to pay the suppliers, because the suppliers days went up during the period under review. Okay, that's an issue there. Then number two, it looks like the entity doesn't have any financing now, because apart from the receivables, their bank is already overdraft. So maybe the entity may need additional injection of capital. Since they are already 47% geared, maybe the injection of capital must come from the shareholders, because they just got some dividend during the year under review. But again, you have to also ask yourself a number of questions, right? Why will an entity pay dividend and even increase the dividend payout, right? Pay a dividend, 25% increase from the previous year. 25% increase from the previous year. Why will an entity pay dividend when it doesn't have any cash available to pay for short-term debt as they fall due? So some managerial issues must be also handled there in the conclusion paragraph. But on the overall, the entity performed much better in the 2023 than in 2022, as indicated by the 39% increase in the revenue, increase in the gross profit margin, increase in the return on capital employed. The only challenges the entity has is its liquidity position and the efficiency of its working capital ratios. Those are the challenges. And so those are the things that we can write recommendation around in our conclusion paragraph. And this is what you need to understand when we talk about the analysis of the ratios. And you have to understand this very well, because yes, you have the guiding principle document on how the analysis is supposed to be used, right? Because you have this already. So you have to follow that guiding principles in writing out the analysis. So look at what I did. Started from asset turnover, revenue, came to gross profit margin, which was given, came to net operating, then you come to ROSI. Because in a question like this, it depends on how the examiner wants to allocate the marks. It's just 20 marks, boom, like that. The examiner can say, oh, the calculation in the A aspect is 8, the analysis is 12. We have seen the examiner doing 10-10 also before. So in as much as the calculations are important, the analysis is equally important. And that is what you must understand in respect of this particular question, analysis of the ratios. So slide 1 here. Slide 2 for us there. And then the gearing position. Then the summary, workflow. And then the pro forma of the analysis. Very important. Very important. Because that's the first thing the examiner is going to be looking at, the entire pro forma. What's happening here? Did you go through the pro forma? Did you write everything that there is to be written? Then the examiner can then get goosebumps in dealing with your calculation, dealing with the English that you have written. But these are the things that you must understand when it comes to this particular question here. And as I mentioned, you can get questions like this and more in our practice questions videos, okay? In our practice question courses. So visit our website, nhyirapremium.com. You can check the description of the video, the first link. Visit the website, and you can get for management accounting, financial reporting, corporate reporting, advanced audit and assurance. You can get questions like this covering every area, the standards, ratios, consolidated financial statements, then issues in respect of the specialized transactions for corporate reporting students, videos on all of these with the practice questions and solutions available. So you can get access to all of these. And if you can sit down, go through these, and that will also give you the opportunity to be able to join our Executive Revision Masterclass, because our masterclass is exclusive for our students. We don't do general public intervention because we don't have time to intervene for somebody. We have our Executive Revision Masterclass where we spend time with our students for a period of time, guide them through the various things that they must understand, give them access to our library of questions, videos, materials, and mentorship to help them to pass the examination. So head on to our website, nhyirapremium.com, and you can get access to questions like this and many more when you enroll in the practice question courses. If there are any questions you have, don't hesitate to send us a message on WhatsApp, or you can give us a direct call, +233 05011499296. You can see the link, the number at the right bottom corner of the screen there in that case. And these are the things you must understand when it comes to this particular question. So I'm going to be wrapping up around here today. Tomorrow, 6 p.m., we'll be having another live stream tomorrow at 6 p.m. So you make a date to join me tomorrow on the podcast at 6 p.m. We're going to be having some interesting discussions tomorrow on the podcast. So make a date and join me tomorrow at 6 p.m. on the stream as we continue with our discussion and bring some practicality into what we are learning and how they apply in the world as well. So enjoy the rest of your weekend. Make sure you have a great weekend. Catch me tomorrow, 6 p.m. tomorrow, or 1800 GMT +00. So 1600 GMT, not 16, 1800 GMT. Tomorrow we'll be meeting and then continue with our discussion for the examination. Thanks very much, and I'll see you tomorrow as we continue with our discussion.